In this episode, we've got a special guest, Ben Towne from Towne Advisory Services from San Jose, California. We're going to follow Ben's career progression. We're going to talk about some technical valuation topics, and he's going to share with us how he's gained efficiencies using outsourcers himself and how he's now started outsourcing valuation service. If you're listening to the audio version of this, just letting you know we've also got the video on YouTube as well. Enjoy. Welcome back to the Valuation Ultimate podcast. I'm Trevor Monahan, forensic accountant, business valuation specialist, and the CEO and founder of the Valuation Ultimate software. We've got a great episode for you today. We're going to pull back the curtain once again and talk to some people behind the scenes and try to have an authentic conversation about what actually happens in the real world. So some of our episodes so far, we've been very technical. We've been a little bit of finger wavering about what you should and shouldn't do. We're not going to be, we're not going to share anything confidential. We're going to go deep and we're going to try to find out the kind of things that you would find out if you're working in a firm of valuers and you had the water cooler talk. We're going to try to get some of that for you today. And today's guest is Ben Towne. So he's a CPA, he's a business valuation specialist. I'll let him go through his credentials so I don't stuff it up. But I've invited him along. I've had a bit to do with Ben with onboarding, maybe with our software or not. So we're going through that process. And just for others that are thinking about the Valuation Ultimate software, what I've done for Ben and I'll offer for others, if they're serious valuers, is I'll replicate one of your reports for free and just show you what our software would give you back before you added to it. So that offer's still there. That's how I've come across Ben. Ben's also got a mutual friend of mine who's a business coach to valuers who was on the last episode, Rod Burkert, pretty well known in the industry. And so great little synergy here. He's willing to spill his guts and tell us how it really works, where he's come from, and he's offering these other services, which is not a pitch fest. He's not paying for this, but he's going to probably talk about some of this outsourcing stuff that he does himself and offers to some other valuers as well. So we're not going to stop him talking about that. We won't edit it out. We'll let him go with that stuff. And over to you, Ben. Tell us about your career. So let's go, as long as you want to. Let's set the scene for everybody listening. Now, we've got different people that are just starting out their journey. We've got people that are dabblers, CPA dabbler valuers. We've got the people at the other end who are, severe forensic accountant nerds who go from court case to court case. And we've probably got the odd business owner and a lawyer sneaking in to see what we're all on about. And so if that's our audience, fill us in where you've come from, where you've got to where you are now, and then we'll just sort of bounce ideas off each other and see what's interesting to talk about.
That sounds great. Hey, thanks, Trevor. So I'm a CPA here in California, although I always say I'm the CPA who doesn't do any real CPA work. I only do business valuations with my virtual firm. So I sit here in San Jose, and we have staff around the country in the U.S. And then, as you mentioned, we also have a back office in India, which we'll talk a lot about. But to kind of set the table, I started out as a quote unquote normal CPA, doing tax and audit at a smaller firm. I really enjoyed starting at a small firm where I could experience just a ton of different things, take control of whole projects at a time, that kind of thing. I did get a little bored of tax and audit, though. They just weren't my passion. And so I started out as a CPA dabbler, if you will. Dabbled in business valuation. In fact, it was a little bit of a family law practice and some of that was very exciting and that I liked. Worked under a mentor, but then branched out from there, realized that I liked the valuation side of it the most, and started a practice that started a department within the small CPA firm that I was at, grew it to 4 people, and then actually left to try to go to a bigger firm. Realized I liked working with small companies, left that big firm after about a year and a half and started Towne Advisory 11 years ago, more or less. And then about 3 years ago, kind of had the idea to start up Assurance Advisors in Gujarat, India. And yeah, it's been a great ride.
So when you started the first firm, what percentage of the work at that point would have been valuation or valuation adjacent kind of advice? Were you doing any CPA work as well?
As little as I could stand,
Yeah.
as little as possible. So, other than, doing a handful of tax returns for, just friends and family and myself and whatnot, very, very little. But, especially when you're a small, solo, I was solo at the very beginning, me and my laptop. It was a little bit more take all comers certainly than it is now. But pretty quickly, I narrowed it down into just the valuation work. It can be a little hard to, make a living off of it um, when you're starting out and because it's project oriented, right? I mean, you never know when you're going to get the next estate or next M&A or whatever it is. But you can now, which is great.
And for those listening who are in that same situation, they're in the CPA firm, they may have dabbled on a few valuations with their boss. And it's, at what point, it's a confidence thing. At what point do you go, yes, I can do this myself. I don't need the boss anymore. Yes, there's qualifications you might need. There's insurance requirements you might have. In terms of like number of valuations you'd worked on, like rough idea, was it 5? Was it 100? By the time you started this practice and said, I'm gonna put my banner out there as a valuer, standalone, just me. How many valuations deep do you think there were roughly?
Oh, yeah, by the time I hung my shingle, uh, that probably was 300, maybe.
Yeah, okay.
I mean, a lot.
Because you do see, I'm
A
just
lot.
saying this because there's people
Yeah.
sitting here probably who have worked on one or two with their boss. I go, oh, I really like that. I reckon I could do that. And it does seem because, we've all, like we spoke before we started recording about templates, we've all got a model. It's bastardized over the years. It come from the boss. That came to him from his boss.
Mhm.
We've added rows and columns and tabs over the years, and some of them is actually broken. No one knows. And then it's easy for a junior accountant because I remember back when I was a junior accountant, I actually had my probation period extended. It was quite bizarre, like which is quite rare. So in Australia, we've got protections for employees where you can't just get
Right,
fired,
right.
right? But if you're a junior trainee kind of role in a lot of industries, you can have this legal probation period where it just gives the employer the option that if it turned out not so great, they can just fire you with no reason. They don't even have to provide like a reason of substandard work or anything. It's just, no, you didn't make it. Sorry, you're out. I had a 3 month probation period from memory, and it got extended for another 3 months because I was the kind of CPA or chartered accountant, CPA, same thing, and we were doing mostly tax work, and it was really client would come with this problem, I'd come up with this solution within the law. Boss would say that's not the solution we're doing something different, and I'd be the one to go, hang on, I've just done 3 hours research showing that what you're proposing, boss, is actually not within the law. And he's like, shut up, that's not all we do here. Like, we do other stuff slightly outside the law. And maybe it was just me not understanding there's grey nuances in that part of the law. And I was sort of that employee that was, damn it, it's got to be right. And then, my probation was extended. It worked out, don't worry. And then, yeah, and I had the confidence, like if you had shown me a valuation back then, I actually remember going to a course around about that time it's a perennial course in Australia. The same people run it. It's been going about 25 years because I went about 25 years ago, and they're still running it now. It's a half day. It's about $500 investment. And they talk about, you only do one method, capitalised earnings. So it's basically an FME method. You look at the P&L, add some stuff back, take an average, apply it by 3, there's your value. And you walk away from that anointed valuer. You have a spreadsheet, which has the nice little place to put your P&L and do the average or your adjustments to the average. And already had 3 built in as well. You didn't have to write the 3 in. That's great. Thanks for that. And no mention of the balance sheet, by the way. And we're valuing shares or stocks. Okay. And then you get a Word document. And so you now go forth, and then you start in real life in Australia, you see these templates every now and then. Someone's been through this. But I would have had the confidence back then, not knowing what I didn't know, to jump out there, and I would start doing it. We were basically doing valuations completely. We were valuing like equity interests by going average profit after adjustments times 3 equals value of equity, ignoring the $300,000 cash at bank surplus asset, ignoring the bank debts, just going and telling people split your stocks this way. You own half the common stock, you write a check for the other guy for half of that number, completely ignoring and because you didn't know what we didn't know. And that was the same as my boss. My boss had been through the same course, presumably. He's basically doing the reports, I'm helping him, he's signing off on these reports. And I think that there's a bit of a mix of people jump too early and they go, right, now I'll go and be a valuer. And I don't necessarily have the skills, and the lawyers engaging them don't necessarily know they don't have the skills, and because they don't read the report anyway. And then if you try to convince them about a technical argument, it's hard to win that argument because they don't know what you're talking about. They don't believe you that you have to do it that way. And so I know we'll have a lot of people at that level in our. What's your advice to someone like that who's cocky, young? I can do this. I've got the templates. The client seems to like what I'm doing. Do you have advice for the? So what I wasn't in that situation because I didn't become a valuer properly for 10 years after. But if I had jumped, got said to you, Ben, look, I'm going to do this. Let's do this. What would you say to someone like me then?
Oh, that's interesting. I mean, after a half a day and a template, I mean that would kind of make you qualify to be a business broker here. Not that there aren't some excellent business brokers over here, but I know exactly what you're talking about. And you might be right on accident, right? That's how that can come out. The I think I jumped too late, to kind of use that terminology. I think I'm a CPA type person, and that's part of my personality. And so that being the case, I waited until I was real sure that I knew at least something, right? That I wasn't going to be the worst out there. And then when I finally looked around and saw some of the work that people were turning out, which was way worse than what I was turning out, okay, now I felt okay to do it. And also, getting enough referrals because that's the other thing. You can be technically competent, but if you don't have the network to give you the revenue, then it's gonna be a short-lived
So,
adventure.
what confidence then? So I know it's project based, but
Uh,
when you started the first time you went out, did you have whispers from clients? Did you have any pipeline, or like by that point, did you personally have referral relationships with other CPAs or lawyers or whoever else is, brokers, whoever's going to refer this work? Did you have, at least you might not have had jobs day one, but at least you knew people that knew you and that you could talk to and you'd probably get referrals off? Like, did you have that set up? Because you're a
yes.
CPA, like you don't want to jump. I was the same. I was pretty much left a job, stressed I had too much work, started a business, like stressed had no work. And it's
Right.
like, well, I don't know what stress is worse. I'm like,
Oh,
I
I
want to go
do.
back to too. I want to go back to too much work,
Yeah.
and a guaranteed paycheck. And I didn't have. I'll tell you what I did, and I'll let you answer it too. But I didn't, because I'd only done probably 20 by the time I started my little practice, and I wasn't just a valuation only practice at that point when I started my first business back in 2009. I was still planning to do some compliance and tax work and that kind of stuff. And then I just had an epiphany that because I was listening to a lot of marketing podcasts, reading marketing books, like I could probably dominate business valuations on Google search. And that's what I ended up doing. And I got all of my work in that first couple of years just from Google Ads actually. The SEO gave me next to nothing. It was just I was spending about $4,000 or $5,000 a month and probably getting at least 3 to 4 times return on that every month, just purely from Google Ads, which then later turned into referrals once someone found you. They, oh, you're okay, and then they get you to do a quote for the next one, etc. But I think you can't do that anymore. Google Ads is way more competitive, way more expensive. But yeah, to answer the question rather than me butting in answering it for you, like what kind of confidence did you have with referrals and things?
So at that point, I'd had a history, and that's what made me confident enough that I probably could get enough work to get there, and then I did. And really, it's the kindness of friends. At some point, I had several friends who were in the industry who said, "Great work, come do some white label work for me," which I did happily, especially early on. About maybe 3 years in, I pretty much cut off all of that just because I had too much work of my own to do. But I mean, for a period of time, it was vital for me and my mortgage, and I think helpful for my friends as well. Uh, and as as we went along, I mean, I had maybe 5, 6, 7 years experience of trying to just get out there, beat the pavement, you know, do the networking, all the in-person stuff. So kind of the opposite end of the spectrum, very old school type of, local marketing or local networking really. And so I knew a number of people who could be, sources. And so I just, kept hammering them for it. And I think there's a much different relationship that you have with a a project when you've been responsible for bringing it in, you're responsible to that referral source, uh, and versus, being assigned something by a partner. And I mean, not to denigrate that at all, but I think that a lot of conscientious people would say, man, that really puts you on your toes all the time when you have to go look at that referral source again, go take them to lunch and say, "Hey, send me another one of those." I don't know. It really forces you to be in it. So what I would say is, yeah, I mean, and maybe that the number of projects that to make you feel comfortable with that, maybe that is 30. I know it's less than 300 or whatever, whatever that
Yeah.
actually was when I went on my own. But I will say it's pattern recognition. So at some point, I was proficient at the different kinds of valuations I was doing, and could recognize that, okay, this one is just like this other three that I had done already, and had gotten through and been able to support in the face of challenge and that kind of thing. So I would say that's when you feel that, then you probably are ready.
Did you go after a certain niche to be known in that niche, or a particular industry or a type of engagement? Did you go after anything, or did it end up? Did you end up being the guy for some kind of thing over time?
It's a good question. Still trying to figure that out.
Well, like if I talk to your referrers, what would they say? Because if you talk to my referrers, they're
uh,
going to say he's the family law guy. I've told you before
mhm.
before this. Like we in Australian family law, we have an assumption as a joint expert, at least initially engaged, and then the parties have to get permission if they want to adduce evidence from another opposing expert, and sometimes you end up with three experts, a joint, and one for each side, both saying the joint's terrible, and the poor judge then often gets three reports to look at. But he'll always give more weighting to the joint unless there's a serious problem that can be proven. So I would be like the joint guy, and how I got that relationship. A lot of it is I'm just so hard nosed with the evidence. Don't try to like. People say, "Oh, can you value it high for me?" I'm like, "I'm not doing a job for you now or ever again." You don't ask me that.
Right.
I'm very black and white with no, no, no. I want to keep doing this for 30 years. I'm not doing that for you or anybody else. And then I'll end up getting told that, oh, he's the guy if you want it done like independently, as
Right.
opposed there's other values who are the mercenaries that like you want it valued high, much higher, much lower. Well, my fee will be bigger for that. Yes, but we can make it happen for you. Like there are values that are known for that kind of
Mhm.
approach. But that's just what I was known for because that's the work I went after and my the way I dealt with people. Not that I was not nice to people, but the way I was just very like, no, no, that's never going to happen. What do you think if I asked your referrers now, what would they say? Ben, oh, he's the guy for this XYZ. What is it? Or if
Well,
you're such a generalist,
clearly I'm the mercenary. No, I'm kidding. The I mean, there's actually a lot of parts there. I mean, first off, I'm going to give a shout out to Cal CPA, the CPA Society in California. Our forensic section, including BV, is just awesome. We share a lot. We're very focused on, doing high quality work, supporting each other, doing high quality, very independent work. And it's just one of the places I go to kind of like refuel my passion for valuation work. And that being said, yeah, you can't, just say I'm going to go one way or the other, and it's really hard, right? I mean, sometimes it is, and even when it's not a adversarial position like in family law, but you sometimes only get one side of the equation, right? So actually on my intake form, I'm actually real specific, just like in an audit. Hey, what is the client's bias? I'm not biased, but
hmm,
what's the client's bias? So I can, put it out there. I know my whole team knows that these guys want this low or these guys want it high. That being the case, we have to be, especially careful when we look at their projections, which way it's probably, inflated, deflated, whatever. So we can make sure we push back on that. Um, I think I
is
forgot
that
your
something? Is
question.
that something? Well, it's more. What are you known for? What kind of
Oh,
engagements? What
sorry.
kind of
Thank you.
niche? You on a tangent about mercenary. You're like thinking, oh, I could make more money doing that. Sounds great idea.
Yeah, certainly probably could. But at the end of the day, what honestly, what I am known for, and these things are related. I am a generalist. If you know, if you can use that as not a bad word. We do a lot of different kinds of valuations, including estate and gift, and M&A and startups. So if anything, one of the things that we do that's a little different than, kind of just, I'll say the average valuation firm is we do work with a lot of tech startups.
Mm.
That's just a function of where I live and where, I'm in Silicon Valley, so there's a few here, and so that's going to be a portion of our book of business.
Well, I've got to ask you this because I did a LinkedIn post on it the other day, and mixed responses. So you may not have seen it. Venture capitalist method. So you don't generally find in textbooks. You find it on venture capitalist blogs, and generally when they're trying to justify to their investors why they've invested at a certain value into something they invest. And the skeptic in me, having never seen one done properly, is and maybe you've seen it, but hopefully you're not doing them. Maybe you are doing them, working in Silicon Valley. But is it? I put it to you: is it just a goal seek? Do you just goal seek the terminal value to get the present value of what you're investing?
That's what they do.
That's,
I,
that's
I,
I'm still
I
waiting for someone to go. Is it just a DCF with a goal seeks terminal value?
Oh no, it's not the thing. And I'm not saying it's right because then again, I don't have to be responsible for other people's money. I'm not getting huge amounts to sit on it and sit on a board. But I would say that the best VCs are incredibly smart, and what they take into account are what's the possible outcome. Yes, discounting it at a super huge number, but also, the bigger piece is what's it going to take to get from here to there in terms of dilution, right? And so that's the big bogey. Hey, if it starts taking way longer, then you get diluted, you get recapitalized, it's all over. It doesn't matter how big that final number gets. So it is a way to get ballparked. I don't use it as a method. It's not a method from a fundamental standpoint. Um, and they don't do a DCF per se either, because who knows? It's just how much cash are you going to burn between now and then being, when you have an exit. Uh, I think a less successful VC certainly might use that as a justification when they're not sure. I mean,
Have you ever
if you get a good
seen?
deal, if you get a good deal, you don't have to justify it to anybody. And everybody knows you got a good deal. If you get maybe not such a good deal, then that's when you have to scramble and yeah, back solve into something that seems like it makes sense.
Have you ever seen a non-VC vested interest use a venture capitalist method in a real report, like a court expert report?
Ooh,
Because
that's a
I
good.
haven't. I haven't. Because everyone talks about around the SaaS industry about how important it is a method, but I've never seen an actual real valuer do one. And
Agreed.
my poll on LinkedIn was the same. No one's ever seen one. So I'm just putting it out there in case there's any venture capitalists pretending yes, they think, I do a lot of SaaS valuations as well. Well, not a lot, but do listen to a lot of SaaS podcasts and things because I've got a SaaS business myself. So I'm on the other side of that as well. And I'm happy to do venture capitalists about my own thing. Unless I'm getting
Right.
divorced, then of course that would be just net assets. Can't be any goodwill there. But what I've found is that, and I suppose I even find this with the dabbling valuers, they're like, well, you can't value this the normal way, Trevor. And I'm like, let's go back a step and define what you think normal is. Oh, we've got to take into account the future. I'm like, have you heard of a discounted cash flow?
That
And
is the normal way.
this is
Correct.
people. This is people doing court work. This is so. I'm not, when I say dabblers, I'm still saying dabbling, putting the hand up to do a bit of court work, whether it's a shareholder dispute or a divorce, and they're telling me we can't value this like normal. And I'm like, well, like your normal, buddy, might be different to other people's normal. Like, what do you mean by normal? And they'll say, oh, we can't just average 3 years. I'm like, are you ever doing that? When are you doing that?
Right.
And
Agreed.
because a lot of my work is mentoring other valuers as a paid mentor and as also onboarding them onto our software and giving them feedback on the report, which is
Right.
generally a free service. And a lot of the things I'm picking up is I'll have things, and I've actually seen this in a court case where the expert was asked, will he come up with the future maintainable earnings? as the primary number in his report, using capitalized earnings approach, normalizing blah, blah, weighting average, future maintainable earnings. And then we apply a multiple and we go away. And the question put to them was, is that your best judgment of the ongoing profits or cash flows or whatever you're thinking? Oh no, that's how the calculation works out. I'm like, you've got to be like, there's a hint in the name. Is the future maintainable earnings. If it's just how your calculation works out, and you're here for an opinion, but it's not your opinion of the future maintainable earnings, then maybe your calculation needs some work. And I think it's this disconnect. Again, it's not that it's a cookie cutter, but we've got our templates. We run through the process. We've got our Word document which has the same generic words in it, and we think our calculation works, whatever that means. And away we go, without stopping and thinking and going. And it's very easy to belittle someone in court by just bringing them back to words, because the judge doesn't see the numbers. They're like, well, okay, future maintainable earnings. Well, I think I've heard of that before. And then someone's going to ask questions about and then putting doubt in the mind of the expert themselves don't think that's the future maintainable earnings. Then the whole report basically just gets torn up at that point. And I think that's a bit of the shift that I had building the valuation software for me. I've got half a clue. I've read the textbooks. I read the standards. I've done a lot of work. I'm not saying I'm perfect, but just seeing people getting onto the software, I haven't put yours through the report. I'm not picking on you.
Please do.
But, well, let's make that public. Let's do it right now. Let's bring it up on the screen.
Do it right now.
Live critiques, anonymized. Take them. That'd be an interesting live video.
That'd be one of those reaction videos.
I could do it. We could definitely do that. Not even reveal the valuer. Just get someone to volunteer a report, make them anonymous, take all the names out so clients and business names can't be known, and just critique the hell out of the thing and just go. And then even have a group session and people can pile on. It'd be anyway, I'd watch that.
Oh, that would be fantastic.
I would watch that. And maybe Rod should do that in his coaching group. Pull up someone's report and try to guess whose it was.
Oh well, I was with you until the guess who it was, because there's just no way that's gonna work out.
That's what you're known for, Ben. You know, for something.
Yeah, exactly. You're the schmuck. And
that's what I've found is that if I go back and look at the support, their help desk questions, a lot of them are things like, your software doesn't allow me to do this. And I'm like, well, you can do whatever you like. Everything's flexible at every point. But why are you doing that? Why are you doing that? And it would be just they get these crazy questions like, but why do you think you need to do that as the valuer? And and it's like, just people telling me you can't. I've had people tell me you can't use, because if you do a capitalized earnings method, you can use the past, you normalize it, you can put forecasts in, you can normalize that if you want. Put a weighted average across all of it, and away we go. Come up with a multiple. And people telling me, no, you can't use forecasts in an FME method. I'm like, why do you get that? Well, it's not in our templates. It's not. Well, I've never seen it. I'm like, well, again, pick up. I've got the books behind me. Pick up Pratt.
Yeah.
And to get to the capitalized earnings method, you have to go past the DCF method. They all start with the DCF. I don't remember any that start with maintainable earnings and then go DCF. They go DCF, and you're doing a DCF, but it's a shorthand, and it's still forward looking. But people can't get their head around the fact that these income approaches, whether it's DCF or FME, they're still forward looking valuations. And I'm talking more than half of the people I deal with, and they're not just dabblers. And I don't want to name names. The other fundamental issue I get is,
hey, it's your podcast.
I can name names. I can cut it out.
You can do whatever you call it. You can feud with anybody you want.
The other fundamental problem is mixing the income and market approaches. And I'm saying this because there's people listening to our podcast who are up and coming. They just need to get this through the head, or they're experienced in doing it possibly the wrong way. They're going to get called out. But income approaches and market approaches are different chapters in the textbooks. They're different sections in national standards. You can have some overlap. Because at the end of the day, you come up with, if you're doing market value, fair market value, you've got to think about the market. But we had this situation where we had a very good expert, very expensive report, capitalized earnings approach, income approach in accordance to accounting standards, as stated in the report, but then goes on to say that in this method, you adopt the multiple from market evidence of market transactions. And I had to stop him and go, that's completely the opposite. Like, you couldn't be more, and it reads well, and most people wouldn't even notice that you've said it, and then basically got guideline public company evidence to develop the multiple for an FME. And my main, and I said, well, that's fine. Well, it might have come a reasonable. I said, well, if I come against you, I have to critique your report. I've just got to show that you're not complying with the international standards. I have to show you the textbook. Show me one textbook where it says, in effectively a DCF, which is what you're doing, shorthand version of that, they use a market multiple. Because the issue, and that in this case, you might say, who cares, semantics? I go back and look at it and go, market approach to me, there's only two things that matter. Only two things, a numerator and a denominator. Something sold for some, whether it's just goodwill, plant equipment, but you have to define this lump. What did it sell for and what were the components? That's your numerator. A denominator is what is the thing you're measuring it by. And it could be square foot. It could be monthly active users. We just happen to use revenue or EBIT or EBITDA, sales discretionary
for good reason.
Because there could be good reasons, but there's no more validity to me in sales discretionary earnings versus square feet. Because to me, it's just, we found a metric. That's fine. So let's say we use EBITDA. And then we go over and we do an FME method, normalize the last 5 years, take some kind of weighted average, and then we apply that to that multiple. And my CPA brain as well is going, they don't mix and match because you didn't get a 5-year normalized EBITDA on the denominator side on your market data. So you can't use a 5 years normalized EBITDA as your measure that you're applying against the multiple. You have to, if you're going to do that, you have to use straight EBITDA, unless you know that EBITDA was normalized. But how would you know? And you have to have more detail about the transactions to know that.
Well, and one of the things that and I like the simplicity of how you explain that, because I have a version of that. Not me. I mean, I didn't come up with this. The finance industry, has come up with. You go look back at something very simple like the dividend discount model, and it all comes back down to kind of I call it the one formula that to rule them all basically. You have your value is equal to your earnings or your benefit stream minus or divided by, your risk minus growth. And so that ties in all the pieces, right? And so that turns into effectively an implied multiple of, based on whatever metric you're talking about. And you can reconcile back and forth, back and forth, back and forth. And so this is where I'm in agreement with you about you're making statements. So if somebody uses a terminal value in their DCF based on GPC multiples, fine, but you're making some assumptions that are implicitly saying things. You're saying something about the long-term growth. You're saying something about, well, are you still growing at that point? One of the big things that I've really started using, not started recently, but started, I don't know, half a dozen years ago, is I use the H model quite often in the terminal value, which is, a declining rate of fast growth down to a maintainable rate. Kind of bridges the gap between where you kind of need to use a multiple because the earnings just aren't there to support the value that is there, or that somebody would say, yeah, that company would still sell for a really
to
high
be clear,
multiple.
I don't have a problem with using an exit multiple from Golan public data in a DCF. That's not a problem to me, because it's still a cash flow at that point. You're saying,
Yeah,
because
absolutely.
you're not doing, and it even comes down to something that I picked up a nuance by rereading one of the textbooks and it comes out in, because when I was building the software, I had to make sure I'm complying with the textbooks, because that's I can't be out here telling people they're not complying with the textbooks that make software that doesn't. And you can bend it so it doesn't comply with the textbooks, but the defaults do. And so when I'm looking at building a terminal value, this is the hard thing about building software. I know how I do valuations. And I know how valuations should be done, or at least I think they should be done. But I also know the other valid ways other people are doing them, that it's not for me to stop them doing them. So the hard part about software is not going, build a form where I can get that number, and then multiply together to get that number. It's no. What are all the different ways someone could get to that number? How do I build in we call them like little joints. Like, where are little joints where you might need to turn and sort of twist and your levers and dials to get to that number. And there's some commonality because we've all got the same kind of models in some ways. But when you get to that Towne Advisory, so the choice was, okay, so we use the Gordon growth model, okay, and we use some kind of exit multiple, or you just basically come up with a number, the ventures capitalist method. We haven't yet built the goal seek button, but we probably will at some point. Like just like what do you want the
That would
present
actually be
value to
really
be?
that would be really useful from the standpoint the goal seek. We actually do that often, and I'll say in one specific area, right? You use that for when you know what the value is because maybe it's a purchase
Yeah,
price
yeah.
allocation, for example, right? So
Yeah, yeah.
there are some or tell you what, if you're analyzing an offer, um,
Yeah.
that may be a way, a way you want to look at it. Like, hey, that's great, but that's really only implying a return of
Yeah,
X, Y, Z.
what makes the what makes the net present value zero?
It,
What kind of
exactly.
whack makes net present value zero? Is this so it's a whack hurdle?
Right.
What is that enough whack for me? Yeah, I could definitely see that. We haven't put in there yet. No one's asked for it yet. But the other thing that came out was and this is something I wasn't aware of, is the timing. So let's say we've got mid-period cash flow discounting for the forecast periods. So we've got, say,
Mhm.
5-year forecast mid-period, which makes sense to most businesses. We on average you get it pretty evenly across the year, unless we're a business that builds at the start or end of the year only.
Right.
And then the question
Seasonal.
comes up: do I give people a different choice for the terminal value? Because a lot of people just go mid-period discounting. And
Yeah.
then when I read into it, and I don't know if it was Pratt, it might have even been McKinsey or somebody, just picked up a little nuance. Like, hang on, if you're doing Gordon growth model, you use mid-period discounting because it's assuming that you're basically you're earning this in perpetuity. There is no exit at that point, even though it's a terminal value. There's no terminal nature
Right.
to this,
Doesn't stop it.
but you exit value, and you're saying we've got data, M&A, guideline public company, whatever. We're going to sell for 6 times revenue, and we forecast revenue by year 5 to be X. So there's your exit multiple, and just realizing that actually should be an end of period discount
Right.
because you've assumed at that day, presumably at the end of the year. Now maybe it wasn't the end of the year, maybe it was halfway through the year, but then you've got to go and
But
fix
you're
the
making
last
an
year's cash
assumption anyway.
flows. You've got to go and fix the last year's cash flows to halve them then, because you're not going to earn the second half of the year anyway. But I don't think I remember seeing in anyone's actual report. Maybe I've just not seen the nuance. And so that was one thing I picked up by building the software. Like, I didn't know everything because I had to learn that, and only read that by going deep and going, surely it was just my curiosity. Is there a way we'd maybe discount that last terminal value differently? And like, yes. But trying to explain that to people who aren't even aware of how discounting works, that's another problem. But we do have the other choices as well. When people doing the Gordon growth, basically going, okay, that times, and basically doing an FME calc at the last period, I'd always use free cash flow. But what I'm finding, a lot of people are using EBITDA, going and basically doing, because if I go back in Australia, when we do an FME method, it's typically on EBIT or EBITDA. Not seeing a lot of cash flow, like free cash flow FME methods, which is strange. My US clients use the software. Most of them, they don't even call it FME, they call it capitalized cash flow method, CCF, because they don't even think about EBIT, EBITDA. But we're just finding a lot of people aren't even doing it. So they'll do a DCF, and then because they think they're just doing a normal capitalized earnings for the terminal value, they'll go and pull back out EBITDA and go and do a sort of thing. I'm like, well, so we build that in so you can do it. What's your opinion on that? Like, just throwing away all these beautiful free cash flows you've just made and saying, no, I'm going to replace that with an EBIT. I can understand with an exit multiple, but what about a constant growth formula for a DCF for a terminal value? Would you be tempted to go back and use EBITDA?
Oh no, absolutely not. So I mean, to follow along with what kind of what you were outlining there, we actually absolutely do. In the rare case anymore that we use an exit multiple, we definitely discount that another half a year because it is a point flow of cash rather than a stream of cash over a year, right? I mean, just what you said. So we do that. We hardly ever use terminal multiples though, because we need to fundamentally understand better than what that kind of shows. Um, Sometimes we still have to do it.
Because is
The
the issue there because your public data is now, and this might be 5 years, and you don't know what the public markets are doing in 5 years?
Yeah, I mean that's always going to be a question or a problem. Um, but at the same time, isn't that what we're doing with every other estimate? Is using today or something. So I think this is where getting it right or getting it accurate more than, trying to be precise is truly the right way to go. I mean, yeah, it ends up being precise because of, how we do things, but really making sure that the outcome is reasonable is the most important thing, given what we know, not only from the data and the facts and circumstances, but also our experience. And to your point, as you were building out the software, one of the issues is you got to know the right questions. And so, like, for example, when we were teaching our team in India, one of the big things was, look, this valuation, unlike other things, it's not just deductive, it's inductive too. You have to realize that there may be part of the story that's not obvious, that's not there. Sometimes there's no, maybe there's only one end of the line that you're trying to draw, and you have to figure out where the other end's going to be. To go back, and this is something I wanted to mention earlier, but to go back a little bit on what you're talking about with the VC method, speaking of just going off into space, um, does anybody use it? No, except kind of. There is, for example, a probability weighted expected return method, the PWARE method, where yeah, you look at what might happen on a probability scenario basis. I try not to use it because it's harder to audit when people want to audit it, and people want to audit it all the time. But at the same time, sometimes you have to say, well, it's 60% likely that this outcome is going to happen and 40% this. And you try to get as you sensitize it, try to calibrate it, do as good of a job as you can there, and then then that becomes part of the valuation. So, for example, we were doing my team and I were working on one for a valuation for convertible debt, and we kind of had to do that,
You
and that's
have to
just part
with
of the
binomial or black or your Monte Carlo. Yeah, yeah, because that's what the market needs. The market's doing that. The market's thinking about what's the probability of this, that, and the other. The market's thinking about
essentially
probability of interest rates going up and down and everything else.
right,
And for us to think we're so perfect that we don't need to think about probability, I'm forever saying that to people.
right.
They're saying that it's that whole science versus art conversation. They're going, oh, you had to make this up, therefore it's an art. Well, like pretty much every science makes things up. It's called a hypothesis, and then we test it the best we can. And if we get two alternative outcomes, we put weightings on them.
Yeah.
I'm like, so just because I've done an FME calculation putting weightings on different years, or I've got some kind of complex equity structure where I put different weightings on different exercise things happening or not, depending on the price getting above it. That doesn't make it an art. That's still science.
Hmm.
And like any good science, as the information, like you would have done it the same as me. You value a startup, and then you ask to value it again in a year or two.
Right,
And and like people go, but your value's different. You must have been wrong the first time. You're like, no, we have more evidence now.
right,
we have
correct.
more evidence of the market about the founders, how good they are at hitting their milestones they set to achieve. It doesn't mean that the first, and I will see people trying to almost not goal seek, but trying to keep an eye on the old valuation they did, and look, and if anything, people say, and I've had this argument with people, and they'll say if a startup does nothing but hit its targets, then the value should be the same because isn't the present value the value of all? I'm like, no, the discount rate drops.
Oh,
Once you show you can hit targets, your discount rate just went from 70 to like 35. Like, even if your cash flows and your DCF are the same, and that's what people don't understand is like you've got to make those assumptions. Like to me, in a DCF, often for a startup, and you tell me if I'm wrong, but often the biggest thing is the discount rate. How much risk? And here's a question for you: if you do a few startups, is do you put, and I know the technical answer is you shouldn't, but do you put forecasting risk in the WACC?
oh, heck yes. Partly because we at high enough levels of risk, you're not really using a whack. You're using,
You
quote unquote venture
you
capital.
might look like you're starting with it, but you get to something that didn't have much to do with it. Is what you're saying.
Correct, right? Because nobody's actually building up from a risk-free rate. You're just so far divorced from that. Now you're just thinking about, rate of return as a holistic concept, not as, something that you can easily tranche up
What
into
do you
pre.
say to the people that are probably textbook correct in saying you factor the risks in the cash flows?
Right. Good. Yes, and good luck trying to
And
get that
and
from a founder.
or well, the way I've tried to get around in those cases, so I'm the same. I'll normally put an extra, if I'm going to do CAPM, I'm going to extra alphas for the extraordinary
Okay,
risks,
yes.
forecasting risks and every other risk. If I'm going to try to do it the other way, I'm more like looking at what's the worst case scenario? What happens if nothing works properly?
Right.
And then maybe 2 or 3 different scenarios, the different forecasts, and then probability weight those forecasts, which to me is probably the textbook way to do it. You can tell me I'm wrong, but that's
Oh, I
I've had
would
that
agree.
explained to me by a very, very high valuer who was booed by the whole crowd because
Uh-huh.
everyone just finds it easier to because the
Well,
founders give
well,
me the hockey stick. What do I do with it? I'm not a full. I'm not. It's not part of my engagement to be a forecaster as such. They've come to me with a hockey stick. My only lever and dial is the discount rate to make it make some kind of rational sense. So therefore, I just turn the dial rather than actually. And the textbook and this guy would probably say, go and extend your engagement or force them to get some reasonable forecast done by a third party, and then come back when the forecasts are aligned with reality and are probability weighted. And
well,
then you
and
don't need.
if you could truly do that, then you and I would all be venture capitalists and we'd be making lots more money and no
Yeah.
podcasts. Or
So
maybe podcasts, but just for fun.
well,
Uh,
about how to spend, how to spend $1 billion a year and not go broke still because we'd be that rich. My
exactly.
thing is though, do you subscribe to the concept that most of these startups, when you see the actual investments, not about how to calculate the value, the actual investments these days, and even before AI,
Mhm.
it's a fear of missing out in a full
So,
portfolio approach. I'm going to invest in 25 things. I'm going to put $100,000 whatever into each of them, and if I get a unicorn every now and then, it pays for the rest. Do you think that's what's really happening in a lot? And even before, that is definitely happening with AI, fear of missing out. But even before the AI bump,
and it's always something, right? I mean, and prior to that, there was cannabis, and prior to that, there was SaaS, and prior to that, I mean, and of course, all those things are still going on. But there's always the next thing. There's the Internet 1.0, even though we didn't call it that back in 2000. Those sorts of things. Just everybody gets very excited about, and the quote unquote irrational exuberance. But at the same time, I the fact that there's a practical aspect to what you're talking about more than is it easier to do it one way or to do another way. I mean, we always use that philosophy of the risk can and should be reflected in the cash flows. However, we know it's not a lot of times, and that's okay. But we need to then, and this goes back to where the client's bias is. Hey, look, and this is very, very funny with startups because they don't always know what their own bias is. They usually we're doing it to value their stock options, doing the valuation, and in which case the client bias is low. But these founders, especially when it's really early stage, and this is kind of ties into what you were talking about, putting in $100,000 for, for each of these, kind of at an angel level or whatnot. Um, when you're at that level, it's truly a guess, right? It is just, hopefully they're doing a slightly better educated guess than other people, and that's how they, their portfolio is going to work. Um, but you get those founders who are telling this story and saying, "Hey, we're going to the moon," and they literally have to believe this, otherwise they can't operate. Telling you that, great, in 3 years we're going to be at 500 million of revenue. On the other hand, that's actually counterproductive to what their actual bias is, and it's just really funny to me because sometimes we're just sitting there trying to reconcile that and just discuss it with them. Like, hey, cool, that makes sense. If you gave us less aggressive projections, hypothetically, well, we would probably use a lower risk rate though, right? Because you've given us the optimistic scenario. If you gave us the pessimistic scenario, which sometimes I have clients try to do to us, I'm like, great, cut the risk rate in half because all that projection risk is no longer there. Well,
it becomes
it
particularly
is.
important in a divorce case where you've got a husband who's the founder might be like just valued on assets. This is terrible. He could be shutting down any time. Yet we've had one case where the lawyer for the wife subpoenaed his emails and found we presumed he had been emailing his pitch deck around town, with the hockey stick forecast, and like as recently as like weeks ago saying how much big it is and all the investors lined up, and then you're like, yeah, but it's hard as the valuer in that situation because he might truly believe it and he might think this is going to the moon. There's still a very good chance this all falls to nothing. And to put a value on that, and let's say they've got let's say they've got 5 properties. If I believe the husband and with his pitch decks and all that kind of stuff, and I believe it like he's hoping the investors do, he ends up with a business and no houses. His spouse ends up with 5 houses, and then the business does fall over next month. I should be laughing. Yeah. I should be laughing. And that's why it's a very
hilarious situation.
This is why people I've come with through my career, and I say there's a turning point when you do your first cross-examination. Because you go one or two ways. You go, I'm never doing that again, and I'm going back to tax. Or more like me, I'm like, oh, people actually read my report for once. That's good, and they ask questions about it. I feel loved that people cared enough to read it about time.
Wow, your cross examinations must go a little differently if your takeaway is I feel loved.
I'll tell you how you, and it's in every. I just naturally do it anyway because I'm CPA. I'm conservative. The sky's falling in. I won't want to be sued. I want to be totally ridiculously honest with everybody. My report, the first page is the limitations and assumptions. Right where you see the value, straight after it, on the same page you get limitation and assumptions. So there's a good negotiation book, Never Split the Difference.
Never Split the Difference, yeah.
And that comes up in that as well. Lead with the things they're going to critique you about. Like in any negotiation, are you selling something or negotiating something? Just lead with the things because that gets rid of all their argument. We're not going to use it because that's what, yeah, we've already said that. That's old news. What else? And so I go into a court case, and this is the barrister, the counsel will say, oh, so you didn't have access to audited financials. No, I just used the bookkeeping system. You didn't have a remuneration expert. No, I didn't. I just did my best guess off salary surveys. You didn't do this. You did it. And they're like, yeah, yes, I've said all this. And the judge is sitting there going, well, he's already said that. What do you got on him? And they're like, so this is still your opinion? Yep, still my opinion. The other guy's going, false sense of precision, which gets found out. And my advice to people I'm mentoring is just be brutally honest. Now, in Australia, we have a problem. We don't have a lot of data. We just don't. We don't have dual stats in Australia. We used to have something like it, and they got found to be frauds, and they got shut down because they were getting it from full sale data on websites, not even actual sales, pretending to be actual sales. You've got some business brokers have their own proprietary data. We don't have anything. There's nothing I can buy in Australia like I can dual stats. A lot of time we use dual stats as a cross-check. And so, but you'll still find a lot of people going and go, oh, the models in the industry are between here and here, and here's the median. Like, no evidence in the report. No, they're just completely making the numbers up. But no one's calling them out on it. And it's a ticking time bomb. And I say to them, but you don't need to do, that's just one method. If you don't have market data, don't do a market approach. Come back over to income approach land, and then I have to teach them about WACC because they don't understand, well, where do you get your multiple from it? And where do you get it in a DCF? It's discount rate, but then you use WACC for that, but then we have to convert it pre-tax if you're using EBIT, and then do the less constant growth rate. Like that's, I'm not, and they'll go, I don't understand your philosophy. I'm like, it's not my philosophy. Again, pull out a textbook. And again, this is probably half the conversations with people that do court type reports, not just, it's just frustrating because all I'm trying to do is tell them where to put and click on the software as the founder. I don't want to be having to keep coming back. So I find a lot of my job is then running training and things just so people, not so that they do it my way, but they say, believe me, that's a way. It's not just me saying it. And now
there's something objective. There's something objective.
And that's right. And if you think the multiple should be 2.7, because you've assessed it and you understand the risks, and you are talking about risks in your report, you're talking about reliance on the owner and the length of the lease, and you think 2.7 is a great number, great, right? But don't pretend it's a market multiple. And you might want to do that extra step and develop that, and you'll probably find your WACC turns into a 2.7 multiple if you have the right alphas. Why? And so why hide from that? Because you're going to be, I just try to explain to people, I found when I started doing WACC on every FME job, because I was the same as everyone else, I think it's 3 or 2.5 or 3.5, a little bit of data, not enough to be market approach, but I'm going to use this multiple with a few, paragraphs about why. When I finally went and said, I'm just going to do WACC for every single FME calculation, I find it was so refreshing because I could sit there and I could bring my risks into my alphas and I could explain it. And the good thing is the lawyers don't critique you because they don't know what they're reading. Oh, he must know what he's doing. Look how complicated that is. Rather than me just saying
2%. Cool.
Yeah. Rather than him just saying 2.5 with these 3 sentences why they found, oh, wow, okay. Ooh. And other experts look at it and go, well, that's a fancy way of doing it. I'm just trying to show people that you have data, use it. Don't have data, that's okay. You can still value business without data. Like it's crazy that people are just so obsessed. Even when I see people blindly using deal stats and taking, the average of numbers that are obviously wrong. Like we just taking the average of wrong numbers, you've got a wrong average. And just blindly applying it without it looking at differences in the businesses and just not thinking about it. I don't want to sort of go too deep on that. Let's go back.
Well, and let me pop in real quick. Just in full disclosure, I don't testify because I've had that experience as well. I think I did great. However, I don't like the stress, so I don't testify at all. A lot of my friends do testify, and I have found that one of the causes behind, wait, I know business valuation better than some of the testifying experts. That's fine. And I realize that one of the issues is that at least here, the testifying expert ends up doing a lot of different things in that divorce, income available for support and all of the things. And so there's, 50 business valuation is one of 15 things that they may be
Yeah.
asked to do tracings and da 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 da. So there's the forensic accounting part is as big or certainly bigger than the business valuation. And so that becomes a piece. Whereas for me, that's my whole life, right? That's my whole world. So that's where, I might be in some cases deeper in it than other people. And, it's fine.
So tell me about this. So you've set up this Indian firm, and so was that like how'd that come about? Was that originally just you going, I need more support for me, I need a team, and it's not just about the cost, but you found that like, well, maybe that's efficient. Um, so what were your motivations, and then do you? I don't know for sure. Do you let other people use your team? Is that what you're offering people? Is it some kind of white label, or at least some back end number crunching? What is that all about?
Yes. I mean, you got it basically all nailed there. I've actually used outsourced services of various kinds for the last 5 or 6 years. Uh, it's in fact, if you want to call it outsource, to use somebody in another state or not sitting next to me because we were a virtual firm. Uh, yeah, I mean, since just about day one, if I could find anybody, that is. Uh, at the end of the day, there just wasn't a split in my mind between having somebody, you know, in another next county, in the next state, across the country. Oh, they're in India. It was just a spectrum. And so as it became harder and harder to find people who wanted to work with me at a small firm, um, and who had any level of knowledge. There was a period of time, I think, particularly in the depths of COVID, there was just nobody to find, um, that I could find anyway. Uh, Everybody was still used to, huge salaries and, I don't know. It just wasn't a good match. And so I'd been using outsource in India for about 5 or 6 years. Never quite found that right fit. Even though I recognize, hey, there's some really great synergies that can happen. Ooh, I used the Silicon Valley term. Um, but really, there's some great efficiencies, some really big advantages, and some disadvantages that don't go away. But I could really see it as working with my business model. And so after working with several different ones, I met Nishant Soni, our director out there. He was working at one of the outsourcers. He left to go to another firm, one of the big firms. Um, and he didn't like it. I knew he wasn't going to like it, so I went and recruited him, and kind of together we hatched this idea of, okay, not just him coming over, which I pay you a great salary, do the work with me. Um, but I'll give a lot of the credit to him as well, that he thought, no, I want to do the whole outsourcing thing. And I said, that's amazing. I wasn't hoping for that even. That was off the table just because I didn't think I could find somebody who would want to go there with me. But he did. And we created a subsidiary of Towne Advisory, called Assurant Advisors. It's an Indian company. There's We start out with four lower level staff, right, MBAs right out of college. and trained them up on the way we do things in the US for Towne Advisory, and it just went super well for and for after about a year, it was a little ahead of my timeline, in fact. uh, Nishant's pushing me. He's like, "Hey, let's get out there because this is really working for you, isn't it?" I'm like, "Yes, it is. You're right. Let's get out there." So at the beginning of this year, 2024, that's when I started. Hey, let's talk to different groups, Rod Burkart's group, Cal CPA, New York CPAs, just basically anybody who I could bend an ear for, to put it out there that hey, we're offering these services to other BV firms, which is a little unique. I mean, I would say the one thing that we're providing that is, really kind of the new, secret sauce is, look, they're the team that's now about 12 people is trained just purely the US way, if you will, or just kind of how people want to see things here. I'm not involved in any of it because you don't want me involved in any of it. I have my own firm. However, if you have a problem, you give me a call and we go fix it. Um, so that's where, at the moment we've got, I think, six other clients other than Towne Advisory. Everybody's very happy. Go, you can check out their testimonials on the website. Uh, but yeah, it kind of grew, and grew faster than I had anticipated. But I love it. In fact, I'm going to India at the end of this week to go hang out with the group again, and well, meet the new hires that we've hired since last year.
Oh, cool. And what scope is their work? How much of the actual job are they doing? They're just doing the like they're not interacting with the client, I'm imagining. So you've got to provide them the information, and then what are they going through and doing the schedules? Are they going through and writing the written report as well? And how what's their scope typically?
Yeah. Good question. So I'll say how I'm set up, which is not the same way necessarily as their other clients are. Uh, Basically, I have a manager level interspersed. So that manager level is, the US side team. They're working with the clients directly. I'm really trying to be that partner level person, making the sale, working with the client, being that relationship manager, making sure everything's right in the reports, and then, interacting on the back end as well. But really, yeah, it's the project manager level that's doing most of the nitty gritty of, okay, we need this document, we need that document, conducting the interview, which I'm always on, by the way. But again, they're doing the heavy lifting. It's the Assurant group for in relation to Towne Advisory, and they're doing 70 to 80% of a project usually. So it's all the first run of doing the analysis, all the research, all the writing of the report, and then it goes to the project manager and they make sure that it's all right. The One of the big things there, of course, is the communication. So one thing that we implement in our process is we have to have quote unquote the critical path information uh, before we even start, because unless there's a huge rush or there are reasons why to get out of the process, but the normal process is we're not going to start unless we have all your financials and all of this and all of that, because it's just too inefficient. And we could have half evaluation done forever. That's no good to anybody. So that's kind of that first linchpin of the communication. And then when we get information back, there's of course always missing or questions or whatnot. And that's a huge part, that the Assurant team knows to flag all those things for the project manager. These are the things we're missing. This is and sometimes this is why it's important,
Mm.
as well as these are the questions that are kind of obvious or evident within the data that we're seeing. What is that account? I don't know what that is. Nobody knows what that is. Um, and then, to the extent that there have to be assumptions and estimates, they do it. And this is actually a big leap. We push that team to just keep going. Make an assumption, make an estimate. There's a hole there. Fine, do that, and then highlight that as an area to address. Say why you did what you did, and go for it. That's not necessarily something that is normal in Indian business culture. I think it's becoming much more normal, by the way, but that's something that people kind of have to get trained out of. But also, don't forget, lower level staff have to be trained that everywhere.
Mm.
So that may not even be, as much of a cultural thing as an experience level thing.
So who holds the deal stats, Cap IQ, subscriptions, that kind of stuff? Do they hold their own, or do they log into yours?
So they hold their own, actually. They hold their own.
Okay. So if someone, okay, so if you've got someone listening that doesn't have access to deal stats or Cap IQ, that could be one way to getting access
Yes.
indirectly.
Yes.
Anything else? Because yeah, who's your target? Who's your target as for that service? Is it the small sole practitioner just doesn't have enough time, just wants to spend the time meeting, greeting clients, getting the next client, reviewing report, tabling it,
Right.
or is it the mid-tier firm who just are sick of trying to find people? They've got maybe 3 or 4 or 5 valuers and hopefully a team of 15 to 20 beneath them, but they just can't find the people, or the people are unreliable. Is which ones are they both eligible to use the service, do you think?
They both are, and we're trying to figure out, our exactly what the addressable market is, because on the one hand, the market is changing quite a bit with, it used to be 20 years ago that only the big four firms would be, global in scope, and then the national US firms, and then, but now it's going downstream. So even you know, I'll say a couple hundred person firm is looking at outsourcing, and if they're going to go outsource their tax and audit, or excuse me, let me say global insource by setting up their own firm. Um, they're also going to try to, haul along the valuation and other
Yeah.
ancillary services, and that just makes sense. So yes, absolutely, a firm that's a little bit bigger, into that mid tier, who for whatever reason does not want to have a permanent presence, or doesn't think that, maybe they don't think that the problem is permanent. But in reality, the six other clients that we have, they're all small to little less small clients. Towne Advisory is still the major client. There's a client in the Midwest that has, I think, 3 valuation partners and a couple of managers. And so they're I would say that they're kind of the target, if you will. But I mean, how many of those are out there really?
Oh, infinite. I've found the same with our valuation software. One of the well, not so surprising, but one of the biggest uptakes is it's not about, because people look at valuations, and I've spoke to you about this before. We're so working in silos. We don't like sharing the real truth with their colleagues. Everyone, you just want to say you're making heaps of money and you're busy, even if you're not necessarily. And we all feel like we're competing for the same clients. And one thing I've done just by doing this whole onboarding accountants, because mostly accountants use our software because they need to be able to put P&Ls and balance sheets in, accountants, CFOs. But a lot of the accountants, when I've been given the training, I've been saying to them things like you've got, say, 300 business tax clients. Like, how often do you offer them to value their business? And they're like, well, what do you mean? Why would we do that? Like, because they would typically refer to me as the valuer, not as the software company. Me as the valuer when there's a share. In Australia, we don't have to do as many valuations for tax reasons as the US, which is actually
Mhm.
good but bad for valuers. We only really have to do it if there's a related party transfer of equity. We don't have gift taxes, estate taxes, anything like that where it really has to be valued. And so you might have these 300 business people in your client group who have never had anyone ever ask them ever in their life if they don't want to know what the business is worth. And what we've been finding, I say, well, send a blanket email out to all your business clients and just nothing but, would you like to know what your business is worth? And the response rate's fantastic because like, no, yes, or yes, but do you do that? Really? That's something you do? And when can we do it? And it's like, and then it's just a matter of what you charge. And
Mhm.
that's what I think, and whether that's, I found that's a big take up for our software because they're like, oh no, now 10 people have said, yes, Trevor, what do we do? We're like, we'll come to some more training. You need to get efficient with their software. If they've got Xero or QuickBooks, they can pull the data in and away you go. But if you don't know what you're doing, you probably shouldn't be doing anything. Again, more training, or maybe there's something like this. And again, I would say we'll refer it to one of the valuers that use our software if you don't want to use it yourself, a Trevor or someone else. Or maybe now the outsourcing is the option is, well, hang on, yes, every time I ask clients if they want to know the business worth, they say yes, but I don't want to do it. But the client's willing to pay $2, $3, $5,000, whatever the fee, the going fee is. I think that would be a great, particularly in Australia, because we have We have so many business owners that have no idea what their business is worth because they've never had to know until they
Mhm.
go to sell. Where in the US, they might know at different milestones because it had to be valued for all these other reasons.
Well,
And
I mean, and those different milestones don't necessarily wind up with the number that are a number that you would sell your business for. And
yeah,
so, one of the other things that, we've ended up developing into is exit planning. For
yeah,
exactly that reason, because most of the time people haven't gotten a real understanding of what the value drivers are of the business and how to change it. Um,
I just
well,
challenge anyone on the podcast. If you're an accountant, talk to your top clients and say, "Would you like to know your business is worth?" You won't get a no, and it will
yeah.
just be about, work out, do a template engagement letter for your first one. So spend an hour or two, work out what is the scope going to be, what are you happy to include and not include, and you can limit it. Look at the national standards, look at your own standards. You can limit it down to a calculation engagement. You don't have
Yeah.
to take all the risk on as a full formal valuation. Do whatever you're comfortable with. Make a fee that makes sense to the client for that scope, and your conversions will be huge. And then you've got to do it, and that's why again, like if you're a firm of two partners and 10 staff, you don't all have to be valuers.
Mhm.
Maybe
Just one.
just one person. Maybe it's a way to retain one of the younger up and coming valuers that goes, "Yeah, I'm interested in that, boss. I'll be the champion of that
Mhm.
service," and you support them. You send them to our free training. You use whatever resources you've got with outsourcing and things. But I just find it's an untapped service because people are just too busy or too scared to do it.
Right, right. Well, and I mean, I think given the standards that you have to follow, you can't be a pure dabbler. You do need to be able to take ownership of that work product. And obviously, I'm a little biased by saying that, I suppose, but truly, I mean, if you're a CPA in the U.S., you need to be proficient at what you're doing. Period.
Yeah,
Otherwise, you
and
can
they're
get
not competing with you and I that are doing
no,
all the things that
not
the
at all.
IRS or tax office are going to get a copy of. Or this is just I'm talking here. Get if you want to get involved for variations that don't matter. Where a client would like to know, they know you're not an expert. They know you're going through the process yourself. You're not charging them $20,000 for the job. You're charging
Right.
something that still gets a decent hourly rate. You're not charging a premium, and you just see is this something you want to keep doing, and maybe you do develop an expertise in it. And you're still not going to compete with any of us actual experts because there's so much work going around, and there's people retiring all the
Absolutely.
time, and there's more and more needs. In the tax situations, and just the grey army of business owners are all supposed to be retiring. They haven't yet. But I think yeah,
You've been told
and
that for
just
like 20
and
years, right?
and even yeah yeah
Their whole career.
yeah, and just like it's like they're telling us with AI, we don't need staff anymore. Well, not yet. Well, I need more
Yeah,
staff to use the AI now at the moment.
correct.
But it's just that succession planning is a huge one. So if you didn't want to even target all your clients, target your clients that you've probably already had a conversation about succession planning. They're getting older, and run something for them. Run a webinar for your going to retire in the next 5 years kind of clients. Make it about
Mhm.
them. Tell them about all the tips. Tell them you do a valuation service. Do a valuation in front of them on the screen, a very simple one, and
Mhm.
then ask for the order. Put an engagement letter out there, and wait for them to say no. Don't prejudge with that say yes or no. Just ask them.
Well, and what are the chartered accountants or CPAs, they have the currency that they need, and that's the trust. And
Yeah.
just like, my relationship with a quote unquote offshore, bad word, outsourced firm, in this case, thankfully, it's my own firm, but it starts with the trust because when you trust people, you treat them right both ways, and they have that trust with the client. The client respects their opinion because you've built that trust. And like you said, if you build a process on top of that to, first ask for the engagement for something that they need, the client needs, um, you can build a good practice, just or ancillary practice on that, and for in my view, valuation is a hard uh, industry, hard career, hard profession to leverage. Just like, just like most professions are hard to leverage. I mean, how do you leverage being an attorney or a doctor or whatever? Not that easy, but there are ways. And having great tools like software, like Valuation Ultimate, really can be a part of that equation. And it's important to say part. It's not the whole thing. If you're just using software and the software is the smart part of the equation, then you're not doing a good job, no matter how good the software is. And same thing with outsourcing. The doesn't matter how good the outsourcers are, if you're not competent enough to look at what they do, because you're closer to the client anyway. If you're not competent enough to review that and convey that to the client, then there's a huge value gap in there. The client's not getting the value that they should, even though I think outsourcing is an excellent tool, excellent part of the equation. And so, I've definitely heard the same things about, well, AI's coming, we don't, we'll be out of, all of us will be out of business, or at least we don't need to have any staff anymore, or this, that, or the other thing. I'm like, no, no, no. It's an excellent tool, or will be. And well, just think, I mean, if you have your Indian outsourced staff or wherever, Colombian or whatever, Philippines, they're using AI. Well, now how leveraged are you? They're using the valuation ultimate software and they're using AI to do some of the analysis. Da, 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 da. You're just gravy. I mean, you can have your valuations 90% done, literally overnight, very quickly, very well done, and be able to do the fun part, like actually go out and meet people and
Well,
talk to
and like
them
you said,
about it.
the ultimate part is it's still your advice.
Oh
You
yeah,
need to review the work and you need to agree with it and you need to be willing and able to change it or instruct them to change it. Because I always say to people, valuations aren't calculations, they're a simulation. If you haven't yet simulated the real world, your calculation is not right. Your calculation is a means to an end. Is like when people say, my future maintainable earnings just works out this way. Well, it doesn't matter is that your opinion? And so we're not advocating, I'm not advocating ever with our software. I've gone the other way. Some software providers go, put your figures in and it will value it for you. I'm like, no, no. You put the figures in and you value it for you. It is still your work. We'd have the sensible defaults, but I've been very careful because I have a lot of pushback. No, thanks. I like to do my own valuations. I'm like, what do you think our software is? You
yeah,
have to do, because they've all been sold this algorithm where
right.
you answer some questions, throw the financials in, and it gives the value. All right. And any decent valuer is going to laugh at that. And they do literally laugh in your face about it. I've tried to build something that is just more efficient and safer and more validation checks than Excel and Word. That's all it is. It just has all the tools, has the portal in there. But you're still, if your only service is do the sell of the valuation service, get it outsourced, deliver it direct, you shouldn't be in business. You should be getting sales commission. You shouldn't be having your name on the report. So you should, yeah. So you've got to be careful. So even these doubling accountants, I'm saying low scope, still go to training. We've got a 3-hour webinar that's on our website you can watch. It's a basic valuation, start to finish. I wish I learned 20 years ago. And then pick up a textbook. And once in your life, read the standards front to back. And you'll already be like in the top 25% of valuers just doing
Easy.
that. Just doing that. From what Ben and I are seeing, and even cool people. We had a guy that his multiple was 2.5. He had no explanation. This is under cross-examination. No explanation why the 2.5. So the barrister asked him, why 2.5? He says it's always 2.5. And he's like, for this industry? No, I just always use 2.5. This guy had been doing call work for 20 years. No one had actually asked him why he uses 2.5. He just does, and everyone just lets him. So don't feel like you're inferior. You've just got to do the work because that's what you're getting paid for. Otherwise, you're just a salesman. But you've got to use the tools and don't be looking for the absolute shortcut of outsourcing the advice. It is still ultimately your advice, but you have tools. The same way that accountants don't use spreadsheets to do financial statements anymore. They use software. It doesn't make any less of an accountant just because they use QuickBooks or something.
Right.
So using software, using outsource doesn't make you any less of a valuer as long as you are still taking control and ownership of that work. And if you hand out a report that you didn't review and you get sued for it, you should be, is my opinion, because
Yeah.
as a professional, you have a obligation to the, under our rules in Australia, an obligation to the public at large, regardless who's paying us. And that would be one of the things. You're not reviewing reports. So don't take what we're saying as go off and run a little 2-bit little valuation automation tool business. Do not do that. Do not hand over anything that's not right. But use the automations and leverage off the good work people have done for you to then use your time to make the last little bit of advice and make sure it's right in the end. Do you have anything else to add? And where can people catch up with you if they want to talk to you about getting a valuation done or using your outsourced service? How do they contact you?
Yeah, absolutely. Thanks. So we have our website at www.assurantadvisors.com. And if you want to just talk to me directly, my easiest email is btowne Towne at townadvisory.com. Happy to chat about anything. I think one of the things that, Trevor, you are really trying to put out there, just kind of for the, good karma, good for the industry, just having conversation with other smart people. And you know, sometimes people can be wrong. I can be wrong. You can be wrong. And, the only way we ever find out that, the multiple shouldn't be 2.5 every single time is to talk to other smart people who are willing to go there and be, well, frankly, be vulnerable when we're practicing such that we can be a little bit more rock solid next time.
Yeah. Thanks for your time today. It's been absolute blast. You've been a great guest. Thank you.
Oh, thanks, Trevor. It was great fun.